We recommend a 25 basis point reduction in the federal funds rate. This decision has been made as the economy shows signs of gradual cooling across both sides of the dual mandate. Unemployment has been trending higher, job creation has slowed, and disparities across demographic groups have widened. Inflation has declined significantly from its post-pandemic peaks. Still, progress towards the 2% target has slowed, with services inflation remaining elevated and tariff-related increases in goods prices creating temporary pressures. Monetary policy remains restrictive, with the current federal funds rate above estimates of the neutral rate and continuing to apply downward pressure on growth. Real GDP growth has remained positive, supported by persistent consumer spending. However, looking forward, indicators suggest a softening of demand and narrowing of employment gains across sectors. Financial conditions remain tight even with this recent rate cut. This meeting will review conditions of inflation, the labor market, growth, and financial stability. We will explain how these support our recommendation to cut rates further to maintain our goal of maximum employment and stable prices.
Now, as part of our dual mandate, one goal is to maximize employment. And although unemployment is still fairly low by historical standards, we have seen a gradual uptick in unemployment, both U3 and U6, over the past few years, and especially in recent months. And U3 lies at 4.3% and U6 lies at 8.1%, respectively. And when disaggregating unemployment by race, we see that unemployment for Black Americans has risen 1.5 percentage points since May. And when we disaggregate unemployment by age groups, we see that Americans aged 16 to 24, unemployment for them has risen faster than the aggregate over the past 2 years, reflecting the heightened difficulties that recent college graduates and the youth in general have faced in job markets. And given our goal to maximize employment for every cohort of Americans, and the fact that historically unemployment rates for these groups have tended to predate broader labor market declines, these numbers weigh heavily in our decision.
Meanwhile, the current stance of monetary policy could lead to a deterioration of macroeconomic conditions. Over the past year, the elevated interest rate has represented a significant headwind for the economy and markets. The Fed increased rates steadily in order to combat inflation from 2022 to 2023. Although the federal funds rate has come down from its peak, monetary policy remains tight relative to R star, which is the neutral rate of interest estimated by the Labach-Williams model, has the current federal funds rate above neutral, which could exacerbate the slowdown that we are observing in the labor markets.
Decomposing inflation into goods and services, we observe that they both have contributed to the stickiness. The recent uptick in inflation has come from goods, while service prices keep growing at a steady rate above pre-COVID levels. We attribute goods inflation to tariffs, which produce a temporary increase in prices and do not signal a lasting inflation problem. The persistence of service inflation comes from how prices are set, not a surge in demand. In healthcare, higher staff pay, slow to change contract prices, and steady post-pandemic demand prices keep prices from falling. In housing and utilities, sticky leases and multi-year utility rate cases keep past rent and fuel increases flowing through over time, keeping this category above pre-COVID levels. This persistence doesn't signal overheating, so we're not worried about it as a lasting inflation problem. As we pointed out earlier, tariffs cause a temporary effect on inflation. However, we need to make sure that they do not feed into expectations, thus causing a persistent issue that would have to be tackled. We indeed observe from the University of Michigan survey that households expect higher inflation over a 1-year horizon. Over 60% of respondents mentioned tariffs in their survey responses. This inflationary fear is not shared across financial markets, as the Cleveland Fed 1-year model shows much lower expectations. The 5-year forward rate has stayed stable near low 2% levels, showing investors believe the Fed will keep long-run inflation anchored. Thus, although we see inflation cooling overall, we highlight that inflationary risk comes from household expectations.
Moving to compare consumer sentiment with retail prices, we look to the University of Michigan 1-year expectation compared to retail sales. Here we see that sentiment has fallen sharply, with many households reporting concerns about prices and tariffs, but we see that retail spending has stayed steady. This gap shows that while households say they expect more inflation, they haven't significantly changed their spending behavior at present. For the Fed, that means current consumer expectations aren't yet feeding into actual demand, so the risk of inflation driven specifically by expectations is limited. Offsetting effects based on household income may not signify a dramatic change in spending right away. even as sentiment falls. Thus, outlays tend to lag sentiment, and positive current personal outlays have yet to reflect the falling sentiment and thus a negative change in GDP.
And because the overall economic cooling is particularly noticeable in the labor markets, we can focus more on this side of the dual mandate. And as mentioned before, despite not seeing reason for immediate panic, as unemployment has been slowly trending upwards, but is not historically high by any standards. But specifically, we do see a very worrying sign in the numbers of net job creation, as there have now been 4 consecutive months with less than 100,000 net jobs created. And for context, in the 5 years prior to the COVID-induced recession, we did not see consecutive months with job creation below 100,000 once, let alone 4 months in a row. This is very indicative of the general cooling we see across the labor market. And it is also important to note that for the past 3 years, we have seen negative revisions to the payroll data. And in the past 2 years, especially, these revisions have been increasingly large. And due in large part to relying on historical patterns of firm openings and closings has been an imperative part of the data collection model that gives us access to these numbers. But firm behavior following the pandemic has been anything but the historical trend. And these issues in collecting data and reflect the short-time economic uncertainty that we face and forces us to be especially cautious in our analyses and decisions. And with this heightened awareness for potential corrections, we can now look to obtain a better understanding of the inner dynamics of the labor market supply and demand. We see evidence of broad cooling on the supply front, as for the first time since the pandemic, the civilian labor force has plateaued. And on the demand side, the total job openings have settled and flattened since 2024, indicating that a new steady state has been reached after the labor market churned hotly following the reopening of the economy post-COVID. And overall, these numbers are indicative of the slight and general cooling we see in the unemployment rates. And we also see this cooling reflected in the stabilization of wage growth, as there has been a plateau since 2025, slightly above pre-COVID levels following the surge in wages that was characterized by soaring inflation and the recovery of labor supply. Importantly, this indicates to us that we do not expect a further and immediate threat of inflation in terms of relation to labor costs.
Given the cooling in the labor market in both labor supply and demand, as well as falling consumer sentiment, this raises concerns about GDP growth and recession risk. In the second quarter of 2025, the US economy experienced solid growth, with real GDP increasing by 3.8%. There was a notably strong decrease in imports relative to previous quarters, likely due to the implementation of tariffs, displaying strong consumer behavior across the economy and domestic demand. The Atlanta Fed GDP Nowcast, which shows GDP is predicted to grow by 3.9% in quarter three, compared to a more conservative estimate by the New York Fed Nowcast, forecasting quarter three GDP at 2.3%. We see there is no large deviation of either forecast relative to this quarter, and we can expect that GDP growth will likely reside near or between these two forecasts for quarter three. Thus, we can expect positive GDP growth at a strong rate, reducing fears for economic health regarding GDP specifically. In tracking real GDP, imports, and private domestic final purchases, we see that real GDP growth has stayed positive at 3.8%, an upward trend from the negative 0.6% growth we saw in quarter one of 2025. Private domestic final purchases, a measure of core private demand, is still on the rise but at a more moderate pace than in previous quarters, 2.9% in quarter two of 2025 compared to 3.3% of quarter two of 2024. Imports fell in quarter two 2025 following a large spike in quarter one, and we will continue to monitor this trend as consumer sentiment regarding import and tariff effects takes hold. However, rising GDP and final sales to private domestic purchasers illustrates the strong domestic demand driving GDP forward. Thus, we see the underlying economy is cooling but still expanding, albeit at a potentially more moderate pace. We expect this GDP growth to be fueled by consumer spending rather than firm investment. The decrease in inventories and imports shown here highlight the potential difficulty for firms to maintain their current activity, slowing consumption in the coming quarters if inventories remain small and consumers limit consumption, given consumer sentiment and inventories of firms. However, until there is an established downward trend of falling inventories and imports specifically, we can expect firms to maintain their inventories to support consumer demand, perhaps with higher cost overall. The percent change in real PCE compared to that of gross private domestic investment reveals the decrease in investment as well as the effects of strong consumer spending on PCE. Here, we are watching firm inventories fall as of Q2 2025, which we can assume is a reflection of the previous decline in imports in Q1. As we can see, the decrease in GDPI is largely dominated by this decrease in private inventories, and given strong consumer spending and a subsequent decrease in imports to support these inventories, we can expect a rise in PCE as consumer costs rise, reflected in the graph. Modest growth in firm fixed investment, measuring firm spending on equipment, technology, and structures, is significantly offset by the decrease in inventories, reflecting firm struggles to maintain their overall growth. If we further attribute the struggle to the implementation of tariffs and the difficulties of firms to maintain their inventories among rising import costs, we can expect to see firm investment and growth slow, signaling a potential slowdown for the economy.
Although GDP growth remains positive and strong, it is showing signs of cooling. We should continue to monitor recession risk in order to avoid abrupt deviation from our dual mandate goals. The smooth recession probability, based on GDP growth, employment, and industrial production data, remains very close to zero, indicating no current statistical signal of a recession. Unlike past downturns where probabilities spike sharply, the line today is flat, suggesting that while risks may be discussed elsewhere, this model does not currently indicate elevated probabilities. The SOMRL indicator, calculated from the changes in national unemployment rate, remains well below the 0.5 percentage point threshold that typically signals the start of a recession. While there has been slight upward bump recently, it hasn't approached levels yet that would trigger a formal recession alert. Neither the statistical composite nor the real-time labor market indicator is currently flagging a recession. This contrasts with periods such as the 2008 or 2020 recession, when both measures spiked decisively. This data indicates that the economy is still expanding, although some signs of softening may exist beneath the surface. These indicators highlight a low probability of an immediate recession. The yield curve has historically been a reliable leading indicator of recessions in the U.S. Both the 10-year 2-year and the 10-year 3-month yield curves, which have been inverted for an extended period, have now moved back into positive territory. The 10-year 2-year sits around positive 0.5%, while the 10-year 3-month, historically the most reliable recession predictor, has edged just above zero. History shows that recessions often emerge after the curve uninverts, typically 6 to 24 months, so this indicator shows some recession risk. The graphs show that the rate of borrowing for the short term is now closer to or even higher than the long term, which flattens the curve, meaning short-term borrowing remains relatively expensive. In contrast, longer-term borrowing costs have only recently pulled ahead, again as the curve inverts.
So with mixed evidence from the recession indicators, we can look to cyclical industries to see where the economy is heading and where the danger level truly stands. And notably, we see a very narrow breadth of employment growth across the economy. As other than education and health services, every sector is near or below zero. And historically, during prior recessions, evident in the chart on the right, manufacturing and construction have been cyclical industries, consistently maintaining large negative changes during economic downturns, while, like today, the economy is propped up by the education and health services sector. And specifically, focusing on the cyclical industries, there is a noticeable concerning trend in construction jobs, as recently the graph has approached nearly 0% change in unemployment from the year prior. And since the 70s, a negative change in employment in the construction industry has consistently coincided with the onset of a recession. So we are not at this negative threshold yet, but we are rapidly approaching it, especially in recent months. And manufacturing doesn't paint as clear of a picture, though, as there have been multiple instances over the past 50 years where the employment drops during non-recessionary periods.
Our final policy recommendation is to lower the federal funds rate by 25 basis points. This decision is primarily driven by the labor market, where we have seen unemployment rise to a post-pandemic high and job creation slow substantially in recent months. With headline inflation moving towards a 2% target, labor market indicators, job openings, and decelerating wage growth suggest underlying economic momentum is slowing more rapidly than anticipated. Maintaining the current rate risks unnecessarily constricting economic activity and jeopardizing the full employment mandate. A cut is needed to realign policy closer to a neutral setting, mitigating the growing probability of a growth slowdown driven by overly tight financial conditions. A reduction in the policy rate at this time is necessary in order to provide stability stability to the labor market, support consumer spending, and maintain stable financial conditions. Moreover, relative to estimates of R-star, monetary policy remains tight and precautionary, suggesting the economy may be closer to a recession. We do not recommend a large 50-point cut, as this could signal panic and inflation is not at a level where we think this cut is necessary. Our plan also allows flexibility for upcoming meetings, allowing us to ease monetary policy if labor market deterioration accelerates further. We will be closely monitoring incoming data to assess how the economy responds to this change, and will reevaluate the policy stance at our next meeting.